All right, in this lesson, we're going to talk a little bit about the financial statement auditing process. Now, before we really get started, I want to address this video with another lesson that we're going to be talking about, because both of them are going to be very similar in nature. So in this lesson, we're going to talk about how the financial statement audit process works when it comes to both management and auditors. And so we're going to talk a little bit about what management does and then how auditors fit in there and what they do. In another lesson, we're going to spend some time just talking about what the auditor does. And so in that lesson, you might watch that lesson and then be totally confused. But what we're doing here is we're kind of giving you the 35,000 feet view of how management and auditors work together, and then we're going to give you the 20,000 foot view of how audits work. So both lessons are going to be important to understand, but I don't want you to get confused from this lesson and the other lesson, because it's going to seem like, wait, didn't he kind of talk about that, but then he didn't really talk about that. This is really just focused on management's part and how auditors fit into the picture. The other lesson that we're going to go through just talks about the auditor's process for completing an audit. So to kind of get us started, let's look at here what we have on this board. And what we have here is kind of what main tasks do the management and auditors have. So let's start with management. Now, management here, the first thing that they usually do is implement internal controls. Now, why would they implement internal controls? Well, we learned, in another accounting class that internal controls are controls that management puts in place to make sure that what they're requesting all of their subordinates to do is done in the fashion that management wants it. So remember, in a very big organization, you've got the president, you've got some senior VPs at the top, and then the VPs, and then you might have managers, and so on and so on. Okay. Above them, you've got the board of directors. Okay, so I have this hierarchy right here. And the board of directors are going to advise management or the president on how to operate the organization and what goals the board of directors wants management to achieve. Well, the president, as well as the senior VPs, are going to have to disseminate that information down to their subordinates, right? And so as they do that, we get something called loss in translation. And we know what that means is loss in translation means that what comes here, by the time it gets to here, is now different, okay? And so management puts in internal control so that what the upper management's goals are followed by those that are below it. So an example of internal controls is that if a check is issued over $5,000, there must be 2 signatures on it. That's an internal control. It's a control so that no one person has the ability to write a check over $5,000. Or that when a shipment comes in, before that shipment's put into inventory, it must be counted by the dock worker. And the dock worker is not allowed to know how much we're receiving. So that when the dock worker counts, we take that number and match it against the invoice from the vendor to make sure that what they billed us for is what they ship. Those are controls to make sure all of our financial statements are done, or financial information is done correctly, and that's what we're most concerned with. So management's going to implement some internal controls, and then management, as well as the company itself, are going to conduct transactions. As they conduct transactions, those transactions will accumulate into balances. So for instance, if we make a sale of $1,000, that is a transaction, so we will book a journal entry into the books. At the end of the year, we put all of those transactions, summarizes them into an account balance. Okay, so think of your bank account. Every day you're going to Starbucks or you're going to a coffee shop, you're buying your coffee, and then at the end of the month and at the end of the year, you're going to get a balance left in your bank account based on all your ins and outs. Okay? If we wanted to, we can throw all of that information into a financial planning software, and it will spit out how much you spend at these coffee shops or Starbucks and whatnot. And so that's the summary balance. It's a listing of all the transactions. So same thing here. We conduct our transactions, and then we accumulate all those transactions into balances. Once we've done that, then we prepare some financial statements. So in real life, once we've done all of our transactions for the year, we prepare an income tax return. Okay? And then we issue the financial statement. So that's what management does from the financial accounting standpoint, financial accounting standpoint. Okay. Now, what about auditors? What do auditors do? Okay, so again, 35,000 feet level, bird's eye view. This is what they do. Auditors will obtain evidence, test the assertions, determine the overall fairness of management assertions, and then issue an audit report. So how does this interact with each other? Okay. Well, the process is this. Management will hire auditors, usually at the direction of the upper management, but also of the direction of the board of directors. Okay, so the board of directors or even the audit committee will decide who their auditors are going to be. And so once that's done, there's some terms of engagement. The auditors will give an engagement letter to management saying this is what we're willing to do, how much this audit will take, or sorry, how long this audit will take, how much will it cost. So that's the terms of engagement between management and the auditors. Okay, so then we have all of these things here that management's doing. They're implementing internal controls, they're conducting transactions, and they're accumulating transactions into balances. So us as auditors, our first job is to obtain evidence on all three things here. Now, the first thing that we do is we look at internal control. And we'll talk a lot about this later on, but we look at internal controls to see if we can rely on their controls. If we can rely on their controls, we might be able to get away with looking at less evidence. So for instance, if they're following the controls that all checks over $5,000 are being signed by 2 people, then we're maybe not concerned when checks are issued for 8 or 10,000. We may not have to look as much at that many checks in order to make sure that they're appropriate in value and appropriate in authorization. Okay? So we're going to look at internal controls to give us an idea of how well internal controls are being used and being followed by the entire company. Okay? We'll obtain evidence, and from that evidence we'll make some risk assessments based on the client, and then we will look at their transactions. Okay? And make and obtain evidence on their transactions. And then we're going to look at their balances. So we're going to find evidence here of this stuff here in order to test management's assertions. Okay? We're going to test management assertions. Okay? And the way that we test management's assertions is we look at their financial statements, right? So we look at their financial statements and we say, okay, they're asserting they've got $5 million in cash. Okay, so then we go back to our evidence and see, can we rely on that number based on the evidence that we've obtained? If we can't, then we have a misstatement. And if we have a misstatement, either management fixed that misstatement or we were going to issue a report saying what misstatements we see in the financial statement. Okay, so we test management's assertions, and what assertions are we testing? We're testing the assertions that are on the financial statement. In a previous lesson, we talked about what assertions are. Okay? Then we take all of the evidence that we've gathered and we take all of the information that we've gathered from testing management's assertions and we determine the overall fairness of the financial statement. Now, we haven't really talked a lot about this, but we did talk about it a little bit in a previous lesson in that we're not going to give absolute assurance that the financial statements are presented fairly. And the reason why we're not going to give absolute assurance is because of cost versus benefit. In order to give absolute assurance, we're going to have to audit every single piece of transaction in the accounting book. The problem with that is if we have an organization, a large organization, we would have to look at millions and millions of transactions. And that's just not possible. The cost to do that would outweigh the actual benefit of providing an opinion to the users of a financial statement. So what do? We provide reasonable assurance. And so when we look at determining overall fairness, we're looking for reasonable. Is it reasonable to say that their financial statements are properly prepared and properly done and properly shows the economic position of the organization? And if it is, then we're going to issue a clean report. Okay, we call that an unqualified audit report, and we'll talk more about the types of audit reports in another lesson, but we'll issue a report. If they are not presented fairly, then we may decide to issue an audit report that says that these financial statements are not prepared fairly. Or we may do something called a qualified opinion where everything is good except for this part that we've tested and reviewed. Okay? And so once we've done that, once we issued an audit report, let's assume it's a clean report, they're doing all of their books the way that they should be based on US GAAP, then we're going to go ahead and give them the audit report, then they will attach that audit report to the issued financial statement, and then they'll issue the financial statement to the external users of those statements. Okay? So again, 35,000-foot view of what financial statement audit process looks like. We've got management doing this stuff, and then we have auditors doing this stuff with this information. Okay? Auditors are going to obtain evidence on the internal controls and the transactions and the transaction balances, and then we're going to test assertions based on using our evidence of the financial statement that we're given to prior to release. We'll determine the overall fairness based on the results of our management assertion test, as well as the evidence that we received, and then we'll issue an audit report based on our determination of the fairness that will go into the issued financial statements and then subsequently given out to external users of those financial statements. So again, 35,000-foot view, this is kind of the high level. This is what is happening on both sides of the fence, and this is what we're trying to do. Again, in the next lesson or in a future lesson, we're going to talk more about what auditor's job is. So now we're going to take away management side of things, and we're going to look straight at auditing and what that auditing process looks like, and we're going to expand this, because obviously this is not just what we do. There's detail to this, and we're going to expand that. So hopefully you have a better understanding of the financial statement audit process from both the management side and from the auditor's side.